We are now going to talk about the concept or the definition of property and deemed property, which is in Section 3 of the Estate Duty Act. So what is property? So property and deemed property, not the same thing. Property is actual property, and deemed property are things which may not be considered property, but which they treat as if it is property. Remember, deemed always means treat as if. So let's see what the Act says. It says, what constitutes an estate? For the purposes of this Act, the estate of any person shall consist of all the property of that person as at the date of his death, and all of the property which in accordance with this Act is deemed to be property of that person at the date. So what this basically saying to you here is that your estate is your property plus deemed property. Alright, so that's what we have to talk about them. So we talk about property now. Property means any right, look at that word, any right, in or to property which is movable or immovable, corporeal or incorporeal, and it includes a couple of things. So let's just first talk about this first bit. This is a very broad definition. Can you see, because they talk about movable and immovable, that means it includes everything which is movable, everything which is immovable. Corporeal, incorporeal means tangible is corporeal, or incorporeal, intangible. So things which you can touch and feel and lick and kick, tangible, corporeal, intangible, things like a trademark. Right. The corporeal and incorporeal things, all of those are included. And it means any right in or to property. So ownership and whatever right you have, if you have a right to earn money from property, then that will be included as well. So it's very, very, very broad. Then it also includes the following things. It includes any fiduciary, usufructuary, or like interest. Now, like interest is a thing like a bare dominium in property, including a right to an annuity. So I'm going to highlight annuity charged upon property held by the deceased immediately prior to his death. Right, so must hold at death and not afterwards. Okay, so I'm trying to say it must mean that it's something that you've had at the time of your death. It was already in your estate. It must not be something that was added at a later stage, so afterwards. So for example, it might say that once you die, your estate becomes entitled to something. That is something that is not at the time of death. So it's only once you've passed away that your estate starts existing, and therefore it happens after death. So that wouldn't be one of these included here. Right, so it must be at the date of death. That's important. Okay, so let's quickly talk about it. So the first thing I want you to see is, I'm going to now talk about these fiduciary, usufructuary, and so forth. Now, the first thing I want you to see is that, I'm just going to write it here, limited interests are things like usufructs, bare dominiums, fiduciary interests, annuities, and annuities will be on property and not on property. Now, for the purposes of tax, your SAICA ITC examinal pronouncements says the value here will be given. Right, so the value here will be given. I do talk about this. We talk about this again a little bit later in the notes for those of you guys who want to find out a little bit more, but this value should be given to you. Now, so I'm not going to, so this is pretty simple, so I'm going to just explain to you quickly what it means. So let's first talk about, I'm going to first talk about a fiduciary interest. Okay, so let's say here's a taxpayer, Mr. A, and he is 50 years old. He has a son who is 8 years old. Right, Mr. A owns a farm. Let's say Mr. A was unfortunately diagnosed with a terminal illness, and he realizes that he does not have very long to live. He wants his son to take over the farm one day, but his son is 8 years old, and 8 years old is too young to farm. So, Mr. A has a friend, Mrs. X, let's say. Right, Mrs. X. He says to Mrs. X, I want my son, this farm must go to my son, but when I die, I want you, Mrs. X, to have a fiduciary interest in this farm. So basically what it means is Mrs. X will look after the farm. She will run it, she will operate it, she will treat it basically as if it's hers. She's in charge of it. Until this son reaches a certain age, let's say. Let's say Mr. A wants the son to reach 21. So Mrs. X will run the farm until the son turns 21, and then all the rights will go to the son. She's never the owner, she's not the bare dominium holder, she's not the usufructuary, she's the fiduciary, she's got a fiduciary interest there. So what it means is that basically, it depends on how this agreement is set up, because it's set up in a lot of different ways. It could say that she takes a percentage of the profits, she takes all the profits, she gets paid some sort of fee, whatever that might be, but she's got this right there. And that has a value, because she's got a right to earn some money because of that. Now, that fiduciary interest, obviously the right will be, it will be given to you. A way of thinking about it is, back in the old days, there would be kings, and sometimes they would have to leave their countries or the places where they live to go and do some work or go into war, and they would have a person that stayed after looking after the kingdom. That's basically a fiduciary interest. Then we've got usufructs and bare dominiums. Right, these ones you might have encountered before, but I always use this as an example. Let's say this amazing thing that you can see. That's a pen. Pen. Right. This is the part that clips into your shirt. This pen, let's say it has a market value of 10 rands. That's the pen in your hand. Now that pen can be broken down into two components. All assets can, basically. It can be broken down into a usufruct, and it can be broken down into a bare dominium. Now the usufruct is the right to use the asset. So for example, if you have the usufruct over this pen, you can use it, you can write a poem and a story and sell it and make money from it. It all belongs to you, but you can't dispose of it. It's not your property. You've just got the right to use it. The bare dominium is the right to own it. Now these two or values have a way of being calculated. There's a way to calculate the usufruct. Now let's say the usufruct is calculated as 8 rands. Then the bare dominium must be 2 rands. That's the idea usually with it. There are some exceptions where there are provisos that could apply and change these amounts a little bit, but that is not something that we're going to discuss here. We do cover it much later on in the notes, for those of you guys who are more interested in that. Right, so these two assets over here, or these two values, or these two rights, most of the time we own both of them. So the pen that you have now, if it's your pen, you've got the usufruct and the bare dominium. Now, it is possible that, let's say, here is Miss Y. She has 2 children, child A and child B. She gives this pen, whatever asset, the usufruct to child A, the bare dominium to child B. Okay, so now she doesn't have the pen anymore because she's given away the entire thing but different assets. Now, if child A dies, the value of the usufruct in child A's estate will be included in child A's estate. So that's where it is. Child B will have the value of the bare dominium. So what I'm trying to say is, it's only when that person dies. So let me explain it in another way. Let's say Miss Y, she dies and she had this asset at the date of death. She will include the full 10 rands. Okay, we'll talk about the value, but for now, she will include that 10 rands in her estate. In her will, she says that child A must get the usufruct of this pen and child B must get the bare dominium. Because when she died, what did she have in her estate? She had the entire pen, so she would get have estate duty on that. Not only the usufruct, not the bare dominium. Child A would have that and child B would have that. So let me explain again. Let's say Miss Y passes away and she says the usufruct must go to child A, but nothing must go to child B. Right. Or let's actually try, that actually would not, that would be the same situation. Let me try it like this. So let's say Miss Y, right, before she dies, she gives the usufruct to child A. So she gives it before she dies, she gives the usufruct to child A. So nothing to child B. So when she dies, what does she have left? Only the bare dominium. So then she will be taxed on the 2 rands, because child A has the usufruct. So if child A dies, child A will be taxed on the usufruct. Okay, so that's very important for you to understand. You need to understand, what did the person have at the date of death? Did they have the usufruct, or was it only created then? Okay, but again, they'll give you that value. Then it says an annuity on property. Now, an annuity on property is, let's say here's a block of flats, right? Mr. A owns the block of flats. He has 2 children, child A, child B. He says when he dies, the block of flats must go to child A. This block of flats earns R1,000,000 rentals a year, let's say. But then he says child A must then, out of that R1,000,000, pay an annuity of, let's say, 60,000 to child B. That is an annuity on property. So it means that property is generating some form of income or some sort of return, and there's an annuity being paid out of that. That's an annuity on property. That's what that refers to. That also has a value. Right, so child B, if child B dies, this annuity has a value in child B's estate. And then an annuity which is not on property is, for example, let's say, we'll see that in a second, let's say Mr. A passes away, and he has a pension that still has to pay out. Right, let's say it's a monthly thing, or a lump sum, whatever the case might be. He's got 2 children, child A, child B. He says this pension must go to child A, but child A must then pay an annuity, child A must then pay an annuity to child B out of that money. That is an annuity which is not on property. Okay, so that's in part B, and then you write to an annuity. And then BA, so much of any amount of contribution made by the deceased in consequence of a membership or past membership of a pension fund, provident fund, or retirement annuity fund, as was allowed as a deduction in terms of paragraph 5 of the 2nd schedule of the Income Tax Act, to determine the taxable portion of the lump sum. Okay. This is pretty interesting. I'm not going to go into too much detail with it, but I want you to just understand. When you calculate a lump sum, the taxable income on a lump sum, and this is something that you've studied separately under retirement benefits, you say the lump sum that was received, less, and hopefully you know what this is, transfers to other funds, or you can remember this is what I'm talking about, less transfers to other funds, and then less past contributions disallowed, or actually just contributions disallowed, let's actually say that. You deduct that, and that gives you your taxable income on the lump sum, and then you look at the tax per whatever table. This past contributions over here is what they're talking about. That past contributions, just as a reminder, if you remember section 11F, it says it's limited to the lesser of 350, 27.5% times greater of remuneration, taxable income, and then taxable income. Right, so you'll remember these rules. I'm not going into too much detail here. Now, let's say the limit that you've calculated was 350. So if you've contributed, let's say 500,000 rands that year to the pension fund, you could only claim 350,000 rands. That 150,000 rands and all of those that you've not been able to claim would end up in your lump sum deduction for taxable income. Now, estate duty says that amount over there that you've deducted from your lump sum must be added as part of your property. This is a reasonably new change. The reason for this is, guys, and this is people who are pretty smart. Let's say, I'm just going to explain to you what they're trying to combat here. So here's this another person, Mr. X. Right. Mr. X has smiling, he has a lot of money in his bank accounts, 10 million rands. But unfortunately, Mr. X is diagnosed with an illness and he realizes that he doesn't have long to live. Now he knows he's going to be taxed on that for his state duty purposes. It's cash in his bank. So what Mr. X does is he takes this 10 million rands and he transfers it, into a pension fund or provident fund or retirement, or actually he transfers into a retirement annuity fund, let's say. Right, so let's say that 10 million rands was then his contribution for the year. And let's say the limit was still 350,000. So that's the only thing you can claim against his taxable income. But this gives him 9,650. Right. That 9,650 then gets deducted against his lump sum. If he dies in that year, the lump sum pays out, let's say, it gets deducted here. So what I want you to see is that 9,650 there, can you see what it does? Is it decreases this taxable income. So it decreases the amount of tax that's payable. And if I then take you just quickly to this slide, just on the next slide, it tells you what is not included in property. They say so much of any benefit which is due and payable by or in consequence of a membership or past membership in a pension fund, provident fund, or retirement annuity fund. So what does that mean? It means that this Mr. X, I'm just going to take you through the story again. He had 10 million rands in his bank account. He paid it into his provident, his RAF. He could only claim 350,000, so there was 9.65 million rands. That was not that he could claim as a deduction then against his lump sum. And let's say his lump sum that he receives is, it's just a thumbs up, guys, 12 million rands. That 12 million rands over there does not form part of his property for his state duty purposes. That's what this says. So, i.e. a lump sum and then retirement annuities. Right. Any of those type of things. They don't form part of estate duty. So you don't get taxed here. Why don't you get taxed under estate duty? Because you get taxed over here in its own form. Right. So maybe there's no tax, but it goes through its own tax system here. So that's why you get taxed here. So they don't want to tax you again potentially under estate duty. But what I want you to see is this 10 million rands that he had in his bank account, he put into his RAF, and that resulted in him claiming a massive deduction against his lump sum, which is then lower tax here, and he's not getting taxed on that under estate duty because there's no more money in the bank account. So SARS didn't want this because this is clever. This is a way of transferring that money out of your bank account into a calculation. So what SARS then said is that 9650 over there, that forms part of your property, and that's what they discuss over here. Right, so what's not included in property, guys? If you're not a resident of the Republic, if you're a non-resident, any immovable property outside of the Republic. If you are not a resident of the Republic, any movable property outside of the Republic. If you are not ordinary residents, you're non-residents, any debt which is not enforced in the courts of the Republic. So if someone owes you money, you're a non-resident, and they owe you money in England, then it can't get taxed here. Right, that debt. Any goodwill, license, patent, design, trademark, copyright, or any other similar right not registered in the Republic. Right, so property is actually intangibles from outside of the country. So you can see most of these guys have to do with non-residents. Sorry, there's one at the bottom also, the person is non-resident. So all of these have non-residents to do with non-residents, and I over here has to do with retirement. Right, so this is just explaining it there, and then how do we determine the value of this property? This is important. Okay, so when you pass away, remember, your executor has now all of this property in your estate, and the executor is either going to, this is basically what happens with the assets. Right, these are the situations you should encounter most of the time. Executor will either sell assets or transfer assets. That's actually the only thing that you can do. Transfer the beneficiary or to someone, or sell the assets. Now, if he sells the assets, then the value that you include in your estate is the selling price. Right, as long as it was a bona fide sale, so a genuine sale, arm's length. If the property was not sold, so if you transfer to someone, then you use the fair market value on the date of death. And remember, guys, the fair market value for farms is the market value times 70%. And then there's a special rule. If you have unlisted shares, now guys, make sure that you hear unlisted shares. Remember, all Pty Limited companies are unlisted, but you also get, most limited companies are also unlisted. So if you see a limited company and they don't tell you it's listed, you have to assume it's unlisted. Be careful. And then you have to know it is unlisted when it's Pty Limited. Right, all listed companies are limited, but not all limited companies are listed. So unlisted shares, you always use the value of the shares on the date of death, regardless whether or not it was sold by the executor. So if the market value is 50 rands and the executor sells it for 70 rands, you use the market value. If the market value is 50 rands and the executor sells it for 40 rands, you use the market value. Only for unlisted shares. For listed shares, you apply our normal rules. Right. That's it for property.